All right, well, let's get started. As I mentioned earlier, if you have questions, drop them in the Q&A button. We'll be taking questions during Ryan's presentation and at the end of the presentation, so we'll do a live Q&A with Ryan. So with that, help me welcome Ryan Standard. He is our senior analyst for fats and oils and animal proteins. And Ryan is going to go into the animal fats outlook for 2020. Ryan, great graphics on your slide deck. Do you want to go ahead and kick this off and tell us what's going on with animal fats?
All righty. Well, thanks, George, and thanks everybody for joining us this morning. It's a pretty exciting day. Lots of big news breaking out there. So we'll go ahead and jump right in. So bullish factors lining up, as you saw from that intro slide. It was kind of a battle between the bears and the bulls, but I would say that the bulls are definitely in the lead and winning very handily right now. This morning we had the news hit that the blender's tax credit has been included in a spending package that's set to be voted on by the end of the week by Congress. It appears as it is now, it's $1 per gallon blender's tax credit in place retroactively going back to 2018. It will include 2019 and then be extended out through 2022. I know there's some scuttlebutt that it's a step down tax credit, but from what we've seen from our DC sources, it's $1 per gallon straight through 2022. So that's definitely good news for the biodiesel producers out there who have been struggling through much of the year. We've seen higher palm prices over the last 6 to 8 weeks. That's definitely had an impact on the tallow market. Export demand has really kicked in. I'll get into that a little bit more in the subsequent slides. The same thing with increased protein or meat demand. For the renders out there, unfortunately, that doesn't mean meat and bone meals picking up. It's the meat for human consumption, and that's driving the feed demand higher in the U.S. feedlots. So we've seen steady prices tied to feed, and we expect that to continue in the coming year. And additionally, we have the CI scores dropping in the California market, which means there's going to be more deficits incurred and a greater need for LCFS credits. So the biodiesel, renewable diesel, and all the other credit generating folks should see increased demand for their products and credits in the coming year. So back into the blender's tax credit. So if this passes by the end of the week, and it seems like there's quite a bit of optimism that it will, it'll be a big win for the biodiesel and the renewable diesel folks out in the market. Especially those who put some big bets early in the year, whether it was a 30-70, 40-60 bet on the split. I think there's some big exposure there, and expect these people are quite happy today and will be even happier this weekend if this thing works its way through both houses of Congress. I think this will have an impact on fats, where we'll see it continue the relative price to soybean oil to continue to be higher than it has been in years past. And I think that's tied to both demand from the renewable fuel sector, but also increased demand from feed. So we'll see that battle between relative price of corn, relative price of soybean oil, as all industries are aggressively seeking, whether it's feed or feedstock, across all grades of fat, from yellow grease up to technical edible tallow. Now, we also expect production and the biodiesel industry to pick back up as soon as possible. There's a lot of plants that have been idled in the second half of this year, and with the retroactive credit for 2019, I imagine those folks want to start producing biodiesel as soon as possible. I think the question that remains is, what do the actual economics look like for the biodiesel producers in 2020? And the RVOs are due out Friday, and so we should have a better idea then about what the complete picture looks like. But don't expect this $1 per gallon tax credit to translate directly into feedstock value. So don't expect feedstock prices to shoot up by $1 per gallon. The RINs are off this morning. We're here trading as low as 40 cents, so that's like a 27% drop relative to yesterday. So those econs are balancing out. And additionally, a big reason for the idling of the biodiesel plants and the drop in demand for feedstock from biodiesel producers in the second half of the year has been difficulty selling finished fuel. I don't think that's going to to change unless something changes with RVOs and the SREs. The dollar per gallon certainly makes it a lot easier for the biodiesel producers to move their fuel, but those economics still need to be established with the RVOs, the SREs, and a complete picture needs to be in place before we get overly excited about, or sellers get overly excited about their feedstock values. Touching back on the palm oil values. This chart shows it's an inverse relationship between the relative price of BFT, Chicago, like Packer Arrender, and Malaysian palm stearine. The lower the relative price of bleachable fancy tallow to palm stearine, the higher the export volume has been historically. And we're seeing that right now. Mexico has come in and they've been really aggressive in their pursuit of bleachable fancy tallow as well as lower acid, technical BFT kind of blends. And we've seen that drive the price of Chicago BFT up over the last couple of weeks pretty sharply. As the saying goes, a rising tide lifts all boats. So continued strength in the BFT market should pull choice white grease, yellow grease, and poultry fat prices higher. So as more buyers, so chemical buyers are competing with export buyers for the BFT, the same goes with feed buyers in the truck market competing with the rail shipments. Move on kind of quickly here and touching on the Chinese or China's pork shortage. And that goes back to what I was talking about, protein demand. We hear estimates from pundits that Chinese hog losses are approximately 40% of their entire herd. So that equates to about 175 million hogs. That big protein shortage for the Chinese consumer has resulted in big import demand from Brazil, Argentina, Australia, and the United States. So we're seeing very strong hog, pork, and very strong beef, pork, and poultry demand, and that's incentivizing big slaughter numbers. We've got record hog kills in the United States that over the last couple of weeks, you're touching on 2.8 million head per week, which is big numbers. But despite those big processing numbers, the rendered output isn't up in conjunction. And that's because the Chinese demand, or a portion of the Chinese demand, has been for carcasses. So they'll take the hogs, split them in half, and there's more bone and tissue going in the export containers, where if it was cuts or boxed cuts, it would be, you see more trim, bone, and even offal going into the rendering stream. So while the per head number is up, the actual output of choice white grease or eventually tallow, those sort of things, is not going to be up in conjunction. The continued spread of ASF, so it's well beyond China, it's expected to continue to drive that protein demand in the near future. And again, the rendered material average yield is expected to fall because there's more carcass and offal exports. An example of this is chicken feet going into China. So there's big consumer demand for U.S. chicken feet now that tariffs or trade flow has been eased, and those won't be going into the rendering stream anymore. Additionally, Australian beef producers, they've been slaughtering a lot of their female herd, and that's tied to terrible pasturing conditions in Australia. There's brush fires, there's drought, so it's been very difficult for Australian cattle ranchers to make money off of their herd. The feed costs are really high, so they've been pushing those things through the abattoirs at a rapid pace. Eventually, they're going to run out of breeding stock, which means there's a big lag coming in the near future. So that's going to translate into additional protein demand from other markets coming from China, but that's also going to translate into more tallow demand coming into the U.S. market that had previously been in Australia and New Zealand from the renewable fuel producers, both domestically and abroad. We've seen some tallow imports come into the U.S. this past year as the sellers there have kind of diversified their customer base, as well as big demand coming from Asian renewable fuel producers. Yeah, again, those volumes of renewable fuels aren't going to go down, so they're going to have to look for somewhere else to get their feedstock, and we expect that to translate into additional U.S. demand. And that touches on another reason why we see, excuse me, continued renewable diesel demand as well as biodiesel demand in the near future is the shrinking LCFS compliance targets, or I should say the bigger LCFS compliance targets and the shrinking carbon intensity threshold. So you see a 7.5% reduction coming in 2020. That means that the CI multiplier that's used to calculate the feedstock value is going to go down. So the producers are going to generate fewer credits from their renewable fuel production, but they should make up that lower credit, per gallon in additional credits sold, because there's going to be bigger deficits coming in 2020 as a result of this percentage decrease in the compliance targets. And just kind of wrapping up here quickly, I know this is a brief webinar, so please, everyone, ask questions and I'll do my best to answer them. It's kind of an all systems go. I mean, it's a positive outlook for all these industries, which collectively make up the vast majority of demand for animal fats as well as used cooking oil and yellow grease. The chemical buyers are seeing good demand for their finished products, I think both because of a good economic outlook in the short term, but also cheaper prices relative to their palm-based competitors. Again, we expect that palm market is going to continue to drive tallow prices higher in the near term. Export, again, is tied to that palm number. Feed demand, all the cattle and hogs and turkeys and chickens that are going to be processed in this next year are going to have a lot of big feed demand, and we expect that to continue to drive demand for animal fats, especially finishing fats for the carcass quality. Biodiesel, big news today on that dollar per gallon tax credit. The same thing with renewable diesel. It was also already seeing big demand into that California market. They don't have the blending hurdles that the biodiesel producers do, so it's been a pretty good year for them despite the absence of the blender's tax credit. And with that, I'm happy to answer any questions that anybody may have.
Okay, so if anyone has questions, drop them in the Q&A section that we have here in Zoom. The first question we have is, what are your estimated ranges for edible tallow values in 2020?
I think that really depends on how high soybean oil goes. I had a conversation earlier with Tori, our vegetable oil analyst, and he said that he didn't think, I have to make sure I have this right, but that 40-cent soybean oil wasn't out of question. And I should double check my notes on there. But if you're looking at a 40-cent soybean oil market tied to tight stocks, big demand, then I think you can easily see edible tallow or edible products pushing towards that 40-cent mark, which is significantly higher than it currently is. But again, that's tied to how high soybean oil goes. I think additionally you have renewable demand that's going to continue to be very strong, and they take, it doesn't matter if it's edible or technical, that low acid and low metal material is needed for both co-processing and some renewable diesel formulations.
Okay. Another question popped in here. What price range do you estimate for yellow grease in 2020 in the LA region?
I would, I hate to pun on this one, but I'd say you have to check out our market intelligence to get a full year accurate forecast. Again, we're still working through some of the numbers on the biodiesel tax credit, and I wanted to see where the RVO goes out, but I don't think it's unreasonable to expect 15 to 20% increase from this year into the California market for 2020.
Okay. What is the percent likelihood that the dollar per gallon tax credit comes back?
Oh gosh, I hate to put numbers on it, but I would, if you were to survey the industry, I think on who's buying and who's selling the tax credit, I would say it's got to be in the 90% range. Again, and this is a plug on the market intelligence, but we do a proprietary survey of industry participants, and that gives a good gauge on the likelihood, or at least the market's estimate on the likelihood that's coming back. And I would say, based on conversations today and what we're picking up from our people in DC, it seems like a very strong likelihood that this thing is going to get done.
Okay. There's a longer question here for you, Ryan, so bear with me. Do you feel domestic chemical buyers will be able to compete long-term 2020 to 2022 for domestic tallow and grease feedstocks if the bio industry continues to get subsidized by the government, and why?
I think it's going to be tough for the chemical buyers to compete for tallow the further along we get, if the renewable diesel projects continue as expected. 2020 and 2021, I think there's some modest growth, but we see huge growth numbers in 2022 from some projects that are in place. So over a billion gallons of renewable diesel production is expected in 2022. If that's the case, then just the demand from renewable diesel alone is easily going to be able to absorb the vast majority of not just tallow, but all animal fats and used cooking oil in the market. And if that's the case, then prices obviously are going to go very high, and they should go very high relative to soybean oil and palm oil. And so I think that that's going to be tough for the oleochemical sector to remain competitive in that market.
Okay. Another question here. What do you think the spread between bleachable fancy tallow versus palm would be in 2020? You mentioned bleachable fancy tallow will go up in price.
Yeah, I think we'll see it trade back above 100%, because that's what at least above 95%, because that's what the domestic buyers, I think, are going to have to pay to keep it away from the export market.
Okay. Well, Ryan, I don't see any more questions that are popping in right now. Thank you for making the time to do this. We're going to have this webinar recorded, and we'll post it up on our site. We'll share out that link with everybody who's been registered here on the call. Ryan, thank you so much for putting this together. And if anyone else has additional questions, should they just email you at that address there?
Yeah, that would be great. Please do.